Woo, baby! Do we got a sponsored video today? Welcome back to Strongman Personal Finance. In this video, we're going to talk about Jack Jackson. Now, I've learned that the other word that begins with M and sounds like Mohana is actually verboten on YouTube, so I can't say it, unfortunately. Okay? But this is a Jack Jackson company. This is a thing that you puff on and you feel real good. I wouldn't know because I've never done it. But I was paid, I was compensated to cover this company and compare it to some competitors. And I just want to give a shout out to Jeremy Lefebvre's stepsister, who compensated me not only for a video, but for a little bit of private time. I'm just kidding. So, what is Green Thumb? They engage in the manufacture, distribution, and sale of various products for medical and adult use. If you're a freaking loser, you use this in the United States. U.S. not, bro. The company offers cannabis, processed and packaged products, in pre-rolls, concentrates, vapes, blah, blah, blah. So it's one of the 1,000 different Jack Jackson companies that is very hard to be profitable because they can't deduct a lot of their expenses on their tax returns, so they get taxed to the wazoo in the United States at least, okay? Now, the stock is going through the hype cycle. Went up during the clown market. Oh, it's the future, bro! And then it's crashed all the way down to $10. Market cap of $2.47 billion on revenue of $1.2 billion. Negative net income, so unprofitable. Earnings per share negative. With a forward PE of 64. So the analysts actually project this stock may be profitable in the future, which is pretty surprising because with all the taxes that these companies have to pay because they can't deduct a lot of stuff in their tax returns, don't forget that, that's pretty incredible. So let's look at the overall history. Revenue went up massively, basically pretty consistently all the way till about mid-2021, and then it's basically flatlined, okay, just like the rest of the freaking industry. Gross profit, they have a positive gross profit. I don't see any plunges there. Let's see, operating margin. So gross margin is in the 50s, high 40s, low 50s. Operating margin is positive, so they're actually profitable from an operational standpoint, but the problem is taxes, which comes after operations. Profit margin, they also have they've had some profitable years, okay? Mostly during the clown market, they started to get a little bit more profitable, but they have been profitable in the past, so at least that's a better indicator than most companies. Free cash flow margin, basically negative. So this is mostly a cash-burning company. But apparently they just announced a buyback, which is incredible. The balance sheet we're going to skip. We're actually going to look at their financial statements. Let's look at their cash flow. So they actually have had consistent operating cash flow. That's pretty impressive for a Jack Jackson company. Okay, they've had consistent and growing operating cash flow. Does that mean it's going to happen in the future? No, but that is impressive. Okay, that is very, very impressive. Capital expenditures have been increasing, so they've definitely been investing in expanding, it looks like, or at least replacing old property, plant, equipment. Acquisitions, they've definitely acquired some companies, but they've also divested. You can see most recently, I think in the last quarter of 2022, they divested and generated $31 million of cash flow. Dividends, they've paid some dividends. That's interesting, okay? Common stock issue. They issued a bunch of stock during the cloud market, it looks like, which is fine. They issued some stock, about $160 million worth. And I guess they're doing a share buyback, okay? Okay, I don't know why they have positive cash flow from share repurchases. It's probably share issuances. But apparently they're doing a buyback. Now, let's look at the ratios. Enterprise value, I don't care about that. PE, okay, they have a PE ratio because they're profitable, shockingly. Price to sales is massively plunged. Price to books, basically it's $1.45 to buy a dollar of equity in the company. Price to free cash flow is negative. That's right, they have negative free cash flow because they're doing a lot of investments. But at least they have positive operating cash flow, I'll give them that. And price to operating cash flow is, I guess, from a value investor standpoint, it's pretty good, right? Now, let's compare this to some competitors. So we got Green Thumb. Let's compare the margins. So we got margins in the low 50s. Let's see what the other competitors have. We got this one, which he told me to look at, True Leaf Cannabis. Oh, I said it again, whatever. This one is a little bit higher margins, but nothing out of the ordinary. It's in the 50s. Okay, these degenerates make pretty good gross margins. This one, Curaleaf, has lower margins. and they're unprofitable. Was cannabis profitable? Is this one profitable? Nope, this is unprofitable. Unprofitable, lower margins. This one, Cresco Labs. What are they doing in those labs? What kind of degeneracy are they engaging in? Lower margins than Green Thumb and massively unprofitable. So overall, I mean, just like on a surface level, you know, looking at the margins at least, Green Thumb is not the worst in the world. Okay, at least they have positive cash flow. But you can see overall the industry, they're having issues with revenue. This is one company. Let's look at this one. Revenue's basically flatlined. We can look at this one. Revenue's going down. I mean, it's basically it's the whole industry. It's not just this company. So if we go look at the company itself, here's some of the products they sell. Like I said, I've never used this crap before, but they have rhythm. You can find your rhythm, bro. The dog walkers, Scott Schaefer should probably advertise these people. What a freak! Wow. What is dog walkers pre-rolls are inspired by simple moments of unconditional, like a walk around the block. Are you supposed to give this to your dog? That's why a portion of our dog walkers go to animal shelters to ensure more dogs are loved and walked often. Yeah, it's Scott Schaefer. Here you go, bro. A bite. You got some edibles here. And an elevated experience with Bebo. What is Bebo? Our luxury line boasts 100% natural ingredients, sophisticated flavors, and occasional centric blends. The sparkly yet functional portfolio is ought to be socially dosed with lower amounts of blah, 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 so you can enhance your day without losing your cool. So if you're like just addicted to this, you need to be high all the freaking time, I guess you can take Bebo. What is this? You can rub this on your skin. Wow. Some very interesting products. Now, let's go look at this company's balance sheet. So, first I like to look at the current ratio. So we're going to compare current assets to current liabilities. So as of September 30th, 2023, they had $320 million of current assets and $149 million of current liabilities. A big chunk of their current assets are cash, accounts receivables, and income tax receivable, with the rest basically being inventory. So when it comes to liquid assets, they have enough, at least as of this date, to pay off their short-term debt. So I'm not really concerned there. Long-term assets, which is annoying, they don't actually break it out, but it's roughly, just over $2 billion of long-term assets. We got property, plant, equipment. We can see they've been buying more. It's increased. Right-of-use assets, these are probably leases that they've signed. Investments, maybe they're acquiring other companies or acquiring small stakes in other companies, not necessarily buying them out. Investments in associate, yep, they're investing in other companies. Intangible assets, that's gone down. And goodwill. So a good chunk of their long-term assets is goodwill. About 25% of their long-term assets is goodwill, but it's not all the assets. And if we look at their equity, even if they wrote down all of their goodwill, their equity would not be entirely annihilated. So that's better than some other companies like, BTI, which is, I guess, kind of related to this, but not really. So total long-term assets about $2 billion, and total liabilities, long-term liabilities of roughly $650 million. So their balance sheet is pretty solid. It's not the worst balance sheet. They have enough liquidity, at least as of this date, to pay their short-term debts. And their goodwill it's a pretty significant part of their assets, but it's not like this overwhelming, oh my God, if they write this down, it's the end of the world. So, not the worst balance sheet in the world. Let's look at their profit and loss. So, let's see, they were profitable. Let's see what's going on here. So, revenues year over year have increased. Looks like gross profit probably went down a little bit. A little bit increase of selling, general, and admin expenses, but nothing crazy, with a very slight increase in income from operations. So it looks like they had a little bit of trouble being more profitable from the operational standpoint, mostly due to cost of goods sold. All right, we got other income and expense. Let's see, interest income, nothing really crazy there. Interest expense. Let's see the taxes. So their taxes are pretty freaking high, okay? Provision for income taxes is 34%. So they have income before provision for income taxes and non-controlling interest, and then they have this provision for income taxes. So their tax rate on their income before taxes is 34, 526 divided by 533, 76%. They have a 76% tax rate. Why? Because on their tax return, they can't deduct a lot of this stuff. Usually on your taxes, you can deduct only cost of goods sold if you're a company that sells an illegal substance. So really, I'm thinking 34, 526 divided by 133, 806. Yeah, that's roughly about, I mean, this corporate tax rate's 21%, but that's roughly what it is. So they're paying 20% tax, 25% tax on their gross profit. That's crazy. That's the problem with these companies. What? But it's pretty impressive that they were able to still maintain profitability after this insane tax rate. But that's crazy. All right, let's look at their statement of cash flows. So once again, they have positive operating cash flow. So they're reconciling from net income all the way down to operating cash flow. Let's see what they're adding back. Depreciation, amortization, amortization of lease assets, stock-based compensation. Yeah, a good $20 million of their expenses were stock-based compensation. Okay. What are they subtracting here? Gain on indemnification of deferred shares with post-acquisition costs. So basically, gains are subtracted, and non-cash gains are subtracted, and non-cash expenses are added back on the statement of cash flows. So you have non-cash expenses and gains up here, and then in this part of the operating section of the statement of cash flows, you have changes in balance sheet assets. So for example, if accounts payable goes down, that means you've paid money, so it would be a subtraction on the statement of cash flows. If accounts payable goes up, that means you've expensed it on the net income side without actually paying cash, so you would add it back, basically. But these are all the adjustments here. You don't have to really understand what that means. But overall, they have positive operating cash flow, and it's improved at least from the prior quarter. I'm trying to see what happened. Big inventory purchase was probably the main difference there. And then they also had let's see. They had some big non-cash gains the prior quarter, which bumped up their earnings. But that's kind of like the main differences between the two. The cash flows for the 9 months ended 2023 and 2022. Let's see. They're still investing in property, plant, equipment. Nothing crazy there. Repurchase of subordinate. Okay, they did buy back some shares. Okay, they sure did. Look at that. So overall, I mean, I'm not going to say this is the worst thing in the world. At least they make money, which is pretty shocking, and they don't have the worst balance sheet in the world. Now, when I say invest in this, I'm not telling you what to do. Okay, if you want a green thumb shoved up your, you know what, maybe you can invest in this. But me personally, I'll probably just stick to VT. Okay, have a wonderful day. Cheers.